Hey traders, welcome to Charts and Coffee. Great to see everybody. Happy Thursday. Hope everyone is off to a good start. We have day 2 of Powell, so time to caffeinate and dominate. He's coming up at 2 p.m. today. So yesterday's Powell event was a big cup of nothing. And even though we had Powell, Williams, Barr, Jefferson, not a whole heck of a lot on the heels of opening remarks from Powell 15 minutes before the bell yesterday. Thursday, today, we got Powell at 2 p.m., which means that throughout the morning session, I'm thinking about, compartmentalize, right? Think as a day trader for a moment. How much movement could we see in terms of traders wanting to front run whatever he might be saying in this panel discussion? Now, the topic matters. Monetary challenges in a global economy, right? Monetary challenges in a global economy is something that is going to touch on, obviously, monetary policy. And that's the pressure point here in the US, because if we're going to continue to see the NASDAQ supported, if we're going to continue to see financials, maybe healthcare recover and keep the movement higher on the S&P or the Dow, it's going to be on the heels of expectations that by the July 31 meeting, the Federal Reserve will have cut quarter point once or twice. That's the track we're on. Now, this is not speculation, gang. I'm not just sort of spitballing here about things that I think. I'm not spitballing here about yields. We're talking about the Fed Fund futures. Here's why I love the Fed Fund futures. Fed Fund futures are not a bunch of analysts coming together and talking hypothetically about things that A, they don't have a position in, or B, they have no skin in the game. I don't care about folks who don't have skin in the game. In fact, even in these sessions, I'm talking my book, right? Nothing else matters. So if I think about where we are going into the July 31 meeting, where we are going into the June 12 meeting, I'm looking at people who are actually trading a futures contract, taking money, putting it into the market on the expectation that the Fed is going to move from the current 525 to 550 basis points, which just is 5.25% to 5.5%, to 5 to 5.25%. It's a quarter point cut. You can see that by June, the expectation is, if you look cumulatively at the 475 to 500 column and the 500 to 575, the first one is this tall one is a quarter point lower. This is a half point lower. By early summer, we're looking at that expectation. By May, again, this is the turn we've been, if I say we, if you're a bull, right? Forget all the apocalyptic, Armageddon, this is the beginning of the end analysis, if I dare even call it that. This is where the dovish turn. This is where money becomes cheap again. Hard to be bearish in an environment where Fed is going to shift that gear again. So I'm not being in any way an optimist or Pollyanna. I'm trying to put my money to work in a way that's macroeconomically sound, that makes sense, that can track to the data, right? And I mention the data because, and I remind myself too, and I tell members in the mastery all the time, who cares what I think? I try not to even say I think, because it doesn't matter what I think. It only matters what I see, right? And, Will had a good point. And not only did that little comment, that speech, as you said, Will from our Essentials room said that speech lasted 3 minutes. So 180 seconds of a pre-written. I can't recall if that was even pre-released, Will. A lot of time when they have these prepared remarks, the Federal Reserve will release them 20 or 30 minutes, sometimes an hour before the actual event. So yeah, you're right. It landed like a feather. Nobody cared. Exactly. Exactly. All right. So why the financials? I do want to mention the financials, gang. Financials are a very important sector when it comes to the Dow, when it comes to the S&P. And one of the things that I mentioned in the video on Tuesday was that when we are looking at what's happening in the S&P, this is micro S&P, mini S&P futures. This is SPY, this is SPX. Gang, all four of those things are trading the same thing, but differently. That's it. So there's no time I'm thinking differently, for example, about the SPX than I would the SPY or the ES futures. Never, right? Am I thinking differently? They're all different variations of the absolute same thing. The 500 stocks, heavily weighted with tech, financials, healthcare. Yeah. Financials matter because if there's a time the S&P could start to play catch up to the NASDAQ or even outperform, it's when this motor of the S&P, and I'll just pull the SPX up because people love this thing, and that's cool. That's fine. But when this thing, the SPX, is going to get moving and grooving, think of it as an engine. It's got 3 cylinders. XLK, tech, already firing away. It's really the only one making this engine move. But if XLF, another cylinder, can start to fire, my gearheads out there, you know what I'm saying. And then finally, if healthcare can at least start to stabilize, if not rally above 131, look out. Everything the 3 major averages need, tech, healthcare, financials, are going to be firing away, and you'll see the 3 indices start moving together. And that's what I'm looking at. So you've got this larger macroeconomic umbrella of the Fed's turning dovish, gang. The evidence is there. We can see it on the rate of change basis on the Fed Fund futures contract, which maps to those target rate probabilities that we can actually graph and measure. No guessing here, right? And then we start looking at, is there a reaction in the sectors that matter, in the stocks that matter to the broader averages? Remember, gang, it doesn't take a lot to move the NASDAQ. It doesn't take a lot to move the S&P. I don't need full participation from all 100 stocks here. We don't need full participation from 500 stocks here. We need about 10 of them to wake up, right? That's why it matters. And that's why I'm very optimistic about finding follow through to the remainder of this year. Remember, gang, we just saw in October some of the most pronounced October year-end mutual fund tax loss harvesting. We have a map now for December. We'll talk a lot more about that in the mastery as we go into December and really the second week of December. So, and then come January, we're prepared. Well, actually, come December 1, we're preparing for earnings season again. So for those of you wondering, okay, Rog, at what time do you start preparing the 642 window in terms of earnings for Q1? That's going to be basically December 1. That's the edge of that 642 window. So a lot of cool things coming. And if 2024 is going to bring potentially 2 rate hikes in terms of cuts, right? I get super excited about that. 2 rate cuts from the Federal Reserve by July 31. Hello. This is the follow through we need. So, and remember, gang, equities have a bullish bias. Do not cling. And by the way, we were talking about this in the mastery yesterday. I don't know where jaded pessimism and uber bearishness started masquerading around as market intelligence. It's not. It is historically at scale going to be wrong. It's going to have certain windows where it looks brilliant. I'm a bear from time to time. But please remember, gang, people tell me, is the game rigged? So it's only rigged in one way. What is that, Rog? To the upside, right? So remember, it's gonna be overall better to look for uptrends, not forcing uptrends, but find those corners of the market that are moving higher. I know that doesn't sound like what we're going to typically hear, because the things that we glom onto are, oh my gosh, this crash, that crash, how terrible everything is. Look, there's a difference between an analysis, right? I was going to say it another way. There's a difference between analysis and actual trading, right? So that's what I'm here to talk to you about, right? That's how we can find opportunity and make winning trades, not sound smart. I know sometimes I don't even sound that smart until the caffeine kicks in. All right, gang, as always, questions the best part of our show. Let's get into it. Kicking it off with Christian. How do we deal with the afternoon lull? I deal with it usually with yoga or the sauna. But how do we deal with the afternoon lull? Lately, it seems like the bullish days, there's always a big 11 a.m. to 1 p.m. sell-off, and then bullish again after 2 p.m. Would it be better to wait for entries? Christian, great question and awesome observation on the time. Yes, time is really the key. So think about this, Christian, and maybe you already know this, and for those of you that don't, two windows for opportunity that I like to focus on. 9:30. So let's open up this 5-minute chart here. In the morning in the Sector Secrets Mastery here in about 8 minutes, I'm going to be talking about my favorite window, 9:30 to 10:35 a.m. Eastern. So can you day trade in 65 minutes and call it a day? Yeah, we do that 80% of the time in the Sector Secrets Mastery. We wake up, we find the relative performers, we put in our limit orders, we wait for the market to come to us, we get our entries, and then after 10:35, we can manage whatever open fills we have. We don't have to be as vigilant at the screens to manage an open trade. We know our stop, we know our target, we just let the market do whatever it's going to do. All right, that's the 65-minute window. And it's the window I like best. Okay, we can also extend that window another 15 minutes to an 80-minute window, right? So I'm not talking marathon sessions here. So about 80-minute window takes me to 10:55. That's 5 minutes before the London fix. If you've never thought about that crazy phenomenon of volatility we see between 10:55 and 11:05, that's an accounting phenomenon. That's a settlement called the London fix. I know it sounds insidious. It's just an accounting thing. All right, then what? My hard stop for the morning, pencils down, definitely no more entries, is 11:30. Backed by data, after 11 into 11:30, volatility contracts, volume contracts. And you might have noticed, as you mentioned so accurately there, so the market sort of floats around like a leaf on the breeze. That's not a time to be trading. There's not as much attention. Folks have gone off to lunch. London's closed. Europe's closed. Yeah. When do we come back? So you mentioned 2 p.m. I like to come back and start to prepare if I'm going to trade the second trading session of the day, 1:35. Monday through Thursday, I'll look at 1:35. Be careful with Friday. Friday has a different psychology because it's the end of the week, right? So now people are not only thinking about taking profit, but they're also considering, I'm going to be hands off the wheel for 2 days, Saturday, Sunday. So there's a different psychology wrapping up the week as opposed to Monday, Tuesday, Wednesday, Thursday. But Monday through Thursday, 1:35 to about 3:05 is that next great window. And so you'll notice if there is good clarity into the second half of the day, start around 1:35. Why 1:35, Rog? Once again, let's look back to when generally volume and volatility start waking up. When are folks coming back from lunch? When is the attention and the flow, money? When is that coming back? And that's what we're tracking. So let it be data driven. In this case, the data that I'm referring to is most definitely volume and volatility. All right. Thank you, Christian. Good stuff. Kevin, good morning. SPY, QQQ, DIA are overbought on the daily with Darvis resistance overhead. Again, remember, that's going to map to ES, NQ, DIA. And let's look at the daily. I love that you're looking at the daily. There's some cool opportunities starting to form. Is it overbought? Slow stochastic. By the way, gang, in my 30 plus years, I've yet to find a better or freer oscillating indicator in a neutral, non-trending environment than a slow stochastic. It's built into most charting platforms. This is something everyone can use. I've been teaching this for many, many years. Listen to me now, believe me later. Slow stochastic, 21K, 3D, 80 overbought, 20 oversold. I'm telling you, it just works. Now, you're right, Kevin, we're sitting at that level. In fact, look at when we were oversold down in here. That would have been around, for those of you looking at your charts, 10/27 to about 10/30, right? October 27 to October 30. Now, we're overbought. Now we can see Darvis overhead. I'm looking at two levels, Kevin. I'm going to look at that Darvis. You're absolutely correct. But here's my thing, Kevin. It's really difficult for me to be super bearish right now in the S&P. Maybe a little bit more in the Dow. So if you ask me, Rog, if you want to, which index would you be most favorable shorting? Oh gosh, without a question, the Russell. Without a question. So if I'm going to prioritize the indices in order of bearish preference, Russell, Dow, S&P, NAS. In other words, the NAS is the absolute last index that I even want to set up a short in. All right, so Russell, Dow. That's going to be very much reliant on exhaustion in XLF, right? And XLF is still struggling. So if I'm going to short, I'd prefer the Dow. I'd like to see the Russell struggle where it is right now, which it is. By the way, another reason I prefer the Dow, and I'm really not 100% certain why this is. I'm sure someone knows, maybe someone a lot smarter than me, but I'll tell you what, energies continue to struggle. Energies are more weighted in the Dow. So when XLE and XLF are struggling, YM looks like the place I'd like to short, second to the Russell. So yes, in those two. I really don't want to short the S&P as much, although there is a potential short if we can get to the daily price movement range and have that overbought stochastic. But I'll tell you, when I did that video on Tuesday, I've been on Tuesday, I mentioned, gang, buy the dips in the S&P as long as that 60-minute is showing that nice overall movement dominated by the green grab candles. So I'm still really 1 hour swing buy oriented on the S&P and even the NAS. And then I'll look at the Dow, I'll look at the Russell, and then I'll look at the S&P for a short. But you're right, on a daily time frame, you're spot on. But let's put the NASDAQ off that list, right? And keep that list in the order of how can we short the Russell, how can we short the Dow? So IWM, DIA, SPY, and let's not even think about QQQ. However, if you do want to short something related to the NAS, let it be consumer discretionary. So take a chunk of that NASDAQ and say, what is the weakest sector in that thing? It's right here in consumer discretionary. So that's, by the way, gang, that's Sector Secrets 101. That's watch list building 101. That's relative performance with emphasis on relative, right? Not relative to some similarity on technical criteria. Why would the different sectors influence each other and influence the index? That's the relative we're looking for. So thanks, Kevin. Good stuff. Let's see. Kudzai asked, what happened to the EMA wave? Nothing, my friend. I'll tell you, the last year, volatility has been rather high. I know that's no news flash. And trends have been scarce. The wave is specifically a trending tool, mean reversion. I like mean reversions within the context of trends, especially longer term trends. They're slowly coming back, hence the wave is coming back. But I've been leaning very much on the daily price movement ranges because of the volatility. We have a number of tools. It's a finite number. I don't have a lot of indicators. I have indicators that help me with volume, volatility, price, and time. Now, when the wave is best to be used is when we have macroeconomic clarity and we have follow through, because all trends, mean reversion type entries, benefit from follow through. That's why 2020 was so great. That's why parts of 2021 were so amazing. And so if we're going to go back into that macroeconomic clarity, if we're seeing more of our individual sectors that are weighted in the indices clear, following through, my friend, yeah, time to bring back the wave. I completely agree. All right. Okay. So that's a wrap, gang. That's how I'm looking at all this. And please, I'm not extremely bearish tech. There are corners of tech that are weak. Let's start with consumer discretionary, but I'd rather prioritize for what's already struggling. Nothing's struggling more than the Russell. All right, gang. As always, thank you so much for being a part of Charts and Coffee, Caffeinate and Dominate, gang. I'll see you tomorrow. Same time, same station. Be good to each other.